Good afternoon, everyone, and a warm welcome to Cowrie Asset Management Quarterly Webinar. We are thrilled to see so many of us joining us today. The theme of today's webinar is Nigerians' Microeconomic and Sectorial Outlook in 2025. My name is Folake Osho, and I'll be moderating the webinar. At Cowrie Asset Management, we're driven by our mission to create exceptional wealth to our stakeholders and customers, and to fulfill our purpose of transforming lives through the power of wealth creation. This webinar is part of our commitment to keeping you informed and empowered with valuable insights on market trends, economic development, and strategic investment decisions. We also want to take a moment to express our sincere appreciation to all our key partners, stakeholders, and special guests for joining us today. To maximize our engagement today, here's a quick overview of the session. That's the webinar dynamics. Our esteemed speaker will deliver an hour presentation on Nigerians' microeconomic and sectoral outlook in 2025. We'll also have an interactive Q&A, questions and answer. We encourage your active participation. You can submit your questions via the chat box just at the bottom of your screen. We'll also allow people to ask live questions. So each live questions will be limited to a minute to ensure we stay on track and give everyone a chance to participate. On our social media, the webinar is being streamed live on all our social media platforms. Social media and the presentation slides will be emailed to your registered email addresses after the event, and the recording will be available on the on-demand viewing on the YouTube channel. For inquiries on our services and products, please feel free to reach out to our team at info@cowrieasset.com. So I'll move to the next phase, which is just introducing our esteemed speaker. Without further delay, let's just dive right into it. Ladies and gentlemen, distinguished guests and stakeholders, please welcome our Group Managing Director, Mr. Johnson Chukwu. Mr. Chukwu has over 3 decades of invaluable experience spanning across various sectors of the Nigerian economy, including capital markets, the banking sector, and all like that. He's a fellow of both the Institute of Chartered Accountants of Nigeria and Chartered Institute of Taxation. Mr. Chukwu has honed his skills through prestigious programs at Harvard Business School and Stanford University. He's also a sought-after media commentator on capital markets, banking industry, and broader economic issues. He will give us a comprehensive overview of the current state of the global and local economy. We're truly honored to have you share your insight with us today, sir. Welcome.
Thank you, Folake. Happy New Year to all our esteemed customers and would-be customers. I guess most people here are customers. Are also, if they're not our customers, I guess after the end of today's session, they will have to sign. They will have the motivation to sign in our customers. Once again, you're welcome to the new year. It's always our delight to have you with us. We cannot exist without you. Thank you once again for your patronage. And we appreciate, we don't take any of those things for granted. So to this morning, this afternoon, depending on where you are in the world, I will be speaking on the global economic outlook, and then I'll drill down to Nigerian economic outlook. So I will share my presentation right away. And at the end, I'll try to compress it into maybe less than enough, to give enough time for people to also ask questions, so that those our esteemed guests, our esteemed participants will also effectively participate in this presentation, so that we can hear from you and probably take some of your questions. So I'm going to start by reviewing the global economy. In 2024, what the IMF as of October said the global economy was going to continue to stabilize and grow at about 3.2%. In the medium term, and the same thing at 3.2% in 2025. Growth is expected to actually reduced in US from about 2.8% estimated growth in 2024 to about 2.2% in 2025. The US economy is projected to have grown about 2.8%, which is quite massive for an economy with a GDP footprint about $25 trillion. In fact, a number of things has happened in the US that may ordinarily even alter the growth rate for 2025. You can see the wildfire in California, where a number of houses have been burned. The country, bear in mind that California is the richest state in the US, and if it was to be a country, it would have been the 5th largest economy in the world. So that state is reeling through a very massive wildfire that will obviously affect its economy. And that will have a kind of dampening effect on the US economic growth rate. The Eurozone grew at about 1.6%. It's expected that the Eurozone will grow at about 1.8% in the current year. The Asian economy, the emerging economies are supposed to sustain their robust growth. Of course, one of the strongest Asian tigers today, though it's not referred as a tiger because of its size, is the Indian economy. Indian economy grew at 7.3% last year. It's expected to grow at about 6.5% this year. China grew at about 4.8% last year. It's expected to grow about 4.5% this year. Latin American growth is actually supposed to decline from about 2.6%. Latin America includes the countries like Brazil, Argentina, Uruguay, Venezuela, and all those South American countries. They actually grew about 2.6% last year, but expected to grow about 2.2% this year. In Sub-Saharan Africa, that is where we all belong to. The economies in Africa, in Sub-Saharan Africa, was expected to have grown about 3.6% last year. Bear in mind that Nigeria is expected to have grown about 3.2% last year, while as the African economy, Sub-Saharan Africa, is expected to grow at about 4.2% in 2025. When we use the word Sub-Saharan Africa, it's good to recognize the fact that we exclude North Africa, because North Africa comes under what they call MENA, Middle East and North African countries. They are considered as a different economic bloc. So South Africa is, and Sub-Saharan Africa excludes the MENA countries, the North African countries. So we are talking of down East Africa, West Africa, Central Africa, South Africa. That's what we call Sub-Saharan Africa. So that region is expected to have grown about 3.6% this year, and is projected to grow about 4.2% next year. Now, coming down further to disaggregate the African growth rate, Ghana is expected to grow about 4.4% last year. Bear in mind that Ghana just passed through a very successful political transition from one political party to another, with the president, the contestant, the president candidate of the then ruling party, conceding victory even before the National Electoral Commission announced the results. And that should be a learning point for our country, Nigeria. Botswana and Senegal are actually expected to grow at 5.2% and 9.3% respectively next year. You can see the robust growth projected for Senegal. Of course, Senegal seems to have been able to deal with its burden insecurity that was rearing its ugly head last year. Malawi, Zambia, and Zimbabwe are expected to grow about 4%, 6.7%, and 6.6% respectively, while South Africa is recovering from a very weak economic performance in the previous years. South Africa is expected to grow about 1.5% this year on the heels of a successful multi-party democracy that obtains in South Africa today, where they have a unity, something you may call a government that includes the Democratic Alliance. And bear in mind that the Democratic Alliance, the white party, was the one that actually built South Africa's economy. So they've come back into an alliance with ANC, and that is rubbing up positively on the economy. We've seen a material reduction in power outage, which has been handed over to the DA to manage. We see a consistent strong economy in the Cape region where Cape Town is. That's also under DA administration. So it looks like DA engagement or alliance with ANC is rubbing up positively on the South African economy. Now, look at the projected growth I just mentioned. The world is expected to grow in 2025 at 2.8%, I mean, the US is expected to grow at 2.2% this year, down from a 2.5% growth, 2.8% growth last year. China grew at 4.8%, expected to grow at 4.5%. Japan grew marginally at 0.3% last year, it's expected to grow about 1.1%. That's a strong growth for an economy of that size. Germany was flat last year, it's expected to grow about 0.8%. UK, United Kingdom grew about 1.1% last year, it's expected to grow about 1.5% this year. And Nigeria grew at 2.9%, it's projected to have grown about 2.9%. We think that growth may be slightly above 2.9%, in the region of 3%, 3.1%. It's projected that Nigeria will grow about 3.2%. And if it succeeds in growing about 3%, that means the projection that IMF has here will be revised upwards. And then you saw India. India grew at about 7.86% last year. India is going to grow about 6.5% this year. And then Russia grew about 3.6% last year. It's expected to reduce materially to about 1.3%. The global economy, according to IMF, have to grow about the same rate last year, 2024 and 2025. The advanced economies are expected to remain flat in terms of growth, about 1.8%. The Eurozone is expected to see an improvement in growth, obviously propelled by Germany to 1.2%. The German economy is the strongest and the biggest economy in the Eurozone. The emerging economies are supposed to remain flat. Sub-Saharan Africa, like we said earlier, is going to grow from 3.6% to about 4.2%. Now, look at what are those factors that impact household standard of living, impacts economic performance. One of these is global inflation. We are seeing a moderation in global inflation since the past 4 years. We saw in 2022, when the Russian-Ukraine war started, there was a major distortion in global economic landscape where food prices jumped up, energy prices jumped up. We saw global inflation at 8.7%. That has moderated to about 5.8% last year, based on the estimate at October, and it's expected to moderate to 4.3% this year. Most advanced economies have gone back into their inflation targets. We've seen countries like UK, US, inflation have moderated, although we saw a reversal of that in the last 3 months of from September. Okay, but this also shows you other countries. If you look at this table, you will see Nigeria is occupying an enviable position of one of the economies with the highest level of inflation at about 34.6% in November last year. The inflation figure is supposed to come out in the next couple of minutes from the Nigerian Bureau of Statistics. So, and the NBS said they are rebasing the GDP and the inflation figure. So we hope to see what the figures will come out to be. But as at November, using the old method, it was 34.6%, and it was one of the highest in the world. If you look at that table, you will see Angola at about 38.4% and Ghana about 23% in November. So what has happened? What have the central banks globally done to either bring down inflation? For the advanced economies that have been able to sustain inflation at about their target rate, or for countries like Nigeria that has to deal with an inflation rate at 34.6%. The US Federal Reserve Bank was cutting down on Federal Reserve rates until the last meeting, where it did a 25 basis point cut to about 4.25 to 4.45% range. But it looks like the current year it looks like it only cut rates by twice in the year by a maximum of 50 basis points. But of course, these things are not recognizing the fact these projections that we have done ahead of the expected impacts of Donald Trump, which I'm going to speak extensively on as we progress in this conversation. So we saw inflation pressure reverse from a declining trend to a northward movement. In September last year, inflation rate was about 2.44%, which is in the region of 2.5, 2.0, 2.5% target inflation in the US. But then that reversed to move to 2.6% in October and 2.75% in November. The same thing happened in England. In September last year, inflation dropped to about 1.7%, which was below the target of 2%. But it reversed to 2.3% in October and 2.6% in November. Of course, the Bank of England had to be more cautious in its rate cut with that reversal. And the last meeting, it decided to hold and not cut further. People's Republic China has a very low interest rate environment. They had to cut down because I'm sure you know that the Chinese economy is coming under pressure, particularly from real estate crisis. So we saw a reduction in what they call loan prime rate, LPR, to 3.1%. I just go through this. Of course, we know the Nigerian Central Bank cut increased interest rate last year by 875 basis points, which is 8.75% to 27.5% at the last meeting in November. It was supposed to meet this month of January because it's supposed to meet every 2 months, but I understand it has shifted it to February. So let's look at the world dollar is going to change, and we believe come January 20th. January 20th is going to be, I think that is going to be on Monday, next Monday. By next Monday, Donald Trump will assume office as the 47th president of America, and bear in mind that he was the 45th president, and he campaigned and won on what he called America First. And America First, if you have to decompose his campaign team, which he is actually living true to his proclamations, America First was driven by a new mercantilist trade policy. A mercantilist trade policy is a trade policy that encourages exports, discourages imports, controls capital importation movement, and centralized currency decisions in the hands of the central government. And he also emphasized the anti-immigration policy. He said that America is going to witness the largest the world ever witnessed of deportation starting from 20th of January, and he's going to sign about 100 executive orders. The number one will be on deportation. But other things that he used to appeal to voters was his position on religion, particularly his position on LGBTQ, where he had made consistent pronouncements on how he's going to deal with that. And then immediately after winning the election, he has ramped up his rhetorics and has threatened to impose new tariffs on China, Mexico, and Canada. For you to understand the import of his threat to impose tariff on Mexico, Canada, and China, bear in mind that a lot of goods, heavy goods, industrial goods, particularly vehicles that are produced in China, in US, are actually manufactured in Mexico, where the cost of labor is cheaper. So in trying to impose tariff on Mexico, is that he wants to move back those manufacturers that moved away from China to Mexico to want to move to homeland USA. He wants to move them back to US. What will be the impact of that? He's threatening to impose tariff on Canada. Canada is the strongest ally, a close ally in terms of proximity to the US. Canada has the longest land border with the US. The longest land border in the world is between US and Canada. And then he wants to impose a new tariff on China, on Canada. Then if you consider China, Chinese economy is about 17 trillion naira today. $17 trillion today. China has evolved from an solely export-oriented economy to an economy with a strong domestic consumption. So China is dominating some sectors than the IT sector. China is actually trying to dominate that sector. So the threat to impose tariff on China will mean that he wants to reduce global production, because the US still remains the largest export market to China. And of course, a reduction in global production will also lead a reduction in resource demand. So these measures are likely going to run against, contrary to the World Trade Organization's initiative to encourage what you call economies of comparative economies of comparative advantage, where countries are supposed to focus on where they have comparative advantage and allow others to produce more efficiently those things they cannot produce, so that they can import from those who produce things more efficiently. This is actually intended to reduce global cost and improve global standard of living. But the US president, incoming president, is likely to step on that. Other things that he has announced that are beginning to frighten, that's not a very strong word to use, frighten the global economic observers, are his threat to take over Greenland, to bring Greenland under US control. He has cited national security and economic benefits. And he has also indicated that he's ready to use, especially using economic pressure on military force to take Greenland. Bear in mind that Greenland is a Danish territory. So what would that lead to? What would it lead to? He has also threatened to take over the Panama Canal. This is a canal that has been relinquished by the previous US presidents. And he has threatened to rename the Gulf of Mexico the Gulf of America, which that means that obviously threatening indirectly to bring Mexico under the American authority. So these are beginning to cause some level of concerns about the outcome of the policies of the US incoming president. At the domestic level, he has said he's going to reduce taxes, personal income taxes and corporate taxes. But bear in mind that US is dealing with a very high fiscal deficit. The US government under Biden has avoided the shutdown repeatedly, by getting the House to grant them further extension or expansion in the deficit funded. So the US government implies that the US government is going to borrow massively from the US Central Bank, Federal Reserve Bank, to fund its activities if it goes into a massive reduction in corporate taxes and household taxes and individual taxes. And the US borrowing from the central bank will mean that the Federal Reserve Bank will print more dollar, and that will create distortions in global money supply and exchange rates, as well as interest rates. The impact of that could be that you're going to see, depending if they fund it through ways and means, you're going to see a lot of liquidity suffix in the US, which will inject liquidity into the global economies. But if they borrow by issuance of treasury bills and other short-dated instruments, you're going to see an uptick in interest rates in the US, and that uptick in interest rate will have a negative effect as it relates to capital flow to emerging economies. So what are the implications of the US Donald Trump's policy? One is that I said earlier that his threat to impose new tariffs on China, Mexico, and Canada will likely lead to retaliatory tariffs by these countries on US goods, and that will drive down or compress global trade. And anything that affects global trade affects the cost of goods, and that would lead to an uptick in cost of goods and services, and ultimately lead to a reduction in resource demand. So remember, when I use the word resource demand, simply means it could lead to a reduction in demand for crude, because that's the major resource, global resource that we produce. Then his neo-mercantilist trade policy will trigger trade wars. We think countries are going to retaliate with trade wars. The countries are going to build trade barriers, which is what we have captured in this image, where you have containers, a container vessel on both sides, but there is a wall separating them from coming to each other. So we think that will happen. Countries are going to build barriers. countries are going to become more nationalistic in orientation, and they will influence elections in several countries. Countries are going to elect people who are more centralist or nationalistic in orientation. And then you also think the trade by Trump to defund NATO, which he has said is going to pose, is demanding for Germany and the likes of Japan to increase the amount of taxes they pay to sustain the presence of U.S. Military personnel in their countries to provide them security. So these countries are going to consider funding their military, arming themselves and funding their military investments. Bear in mind that some of these countries that America is providing protection have the capacity, both in terms of economic resources, in terms of technological development, to build their military bases back. Japan, for instance, had that capacity to build the military resources. Japan is not going to fold its arms if the US threatens to pull its protection of the Japanese territory and watch a possible attack from China that is next door neighbor. So I think Japan and Vietnam, Germany almost single-handedly took on the whole world, and they still have that technological advancement to rebuild their military. So I think we're going to see a military race or an arms race that will lead to economic resources, moving away from economic activities to fund military hardware. And then bear in mind that Trump has also does not believe in climate change and is anti-clean energy. He doesn't believe in all this clean energy thing. So we think the Trump government will fund a lot of production of crude from fossil fuel, from hydraulic fracturing technology. They are likely going to disrupt the OPEC Plus alliance to ensure that Saudi Arabia, who is the major producer that has capacity to increase crude production at short notice, disengage from that OPEC Plus and increase crude production. So we think that will have a negative impact on crude prices, because we think crude prices are going to drop as demand assumes surface. How would that affect the economy? The Nigerian economy will come back to that. So looking at our national economy, I think a couple of people are raising their hand. Today, and those who are raising their hand, just be in mind, just persevere. Once I round up, we open up the conversation for discussion, and we'll call on you to speak on, ask your question, and make your contribution. So looking at GDP, we saw a GDP that grew at about 3.46% in last quarter of last year. It grew at 3.1% in the second quarter of last year, and 2.98% in first quarter of last year. The GDP is expected to have grown about 3.2%, which I think is where we're going to end up averaging this year. Of course, the GDP growth rate was driven largely by the services sector that grew about 3.37% and contributed about 53% of the GDP. Then other sector that saw robust growth was the financial services sector that grew about 30.8%. And then you have the oil and gas sector that grew about, or the oil sector grew about 3.17% last quarter of last year. And then transport sector about 12.2%. What do we make of this GDP growth rate? If you disaggregate this GDP growth rate further, which you're going to see in the next slide, you observe that of the sector that contributed to 5% of the GDP, only 3 of them grew. And those 3 sectors were the financial service sector grew about 30.8%, the ICT sector grew about 5%, and the oil sector that grew about 5.17%. What that means that our growth is still very fragile, in the sense that the major hitters in terms of size of the GDP, which is one, agriculture sector, kind of 38% of the GDP, grew about 1.14%. You look at the manufacturing trade sector, which is the 3rd largest contributor to the GDP, grew about 0.69%. You saw the manufacturing sector that kind of 8% of the GDP grew about 0.9%. So if anything happens to the telecommunication sector, which accounts for about 16% of the GDP growth rate in Nigeria will crash to close to zero. And that's why the federal government, it has become imperative that they listen to the agitation by the telcos to increase tariff, because the government has permitted tariff increase in almost all facets of Nigerian life. And bear in mind that the major inputs of the telco companies are paid for in dollars. Data, we don't produce data here, is paid for in dollars. The major energy source for the fueling of powering of the masts, the transmission facilities have seen a major increase in price. That is diesel. So it beggars logic that the government all this while refused to allow for an increase in the tariff. But so just a further picture that look at the sector that agree. If you look at the sector that account for 5% and above, starting from real estate sector, you see that real estate sector grew by 6.8%. You go to the next, mining and quarrying, where the oil and gas sector is. You grew about 3.27%, which means that if you take out oil production, the other aspects, the solid mineral sector is actually in contraction. Then you see the financial service and insurance 30.8%. So those are the major growth pullers. You see the ICT sector at 5.9%. So it's a major puller, and that's a second largest contributor to the economy. So the same thing is captured here. Then we now talk of inflationary pressure. I've spoken a bit about the inflationary pressures. We saw the inflation rate for the month of November at 34.6%, driven by food inflation at 39.93%, and then core inflation about 28.75%. Of course, we are familiar with what is driving the inflation: food prices, energy cost, pass-through effect of exchange rate depreciation. They remain constant, and that pressure will come from increase in, okay, we'll talk about that increase in tariff that will reflect in inflation figures for this year. Then this is just to show us our government expenditure. Of course, if you look at these tables, you will see that the government, the budget team that you will see from this is that the federal government has continued to borrow to fund its activities since the beginning of this year. If you look at the data from the central bank, total government revenue as of October this year, federal government revenue cumulatively was 6.82 trillion naira, whereas total government expenditure for the same period was 19.61 trillion naira. So if you consider that the government spent, as of October this year, 19.61 trillion naira and generated about 6.82 trillion naira, it then means that government in the first 10 months of this year recorded a deficit of about 12.8 trillion naira. So bear in mind that as of last year, the government is also recorded a deficit of about 10 trillion naira. For 2023, recorded about a deficit of about 20. The implication of this is that the pressures we have on inflation is partly driven by this deficit because government is spending more than it's generating. So it's pumping liquidity into the economy, and what other liquidity is coming from by way of ways and means funding. So while the central bank struggles to suck out liquidity from the economy, the federal government, the fiscal authorities are injecting liquidity into the economy, thereby counterbalancing the effort of the central bank. And that's why you've seen an obstinate inflation rate in the country. Now, looking at what drives economic development, economic growth, is the budget. For 2025, the budget assumptions are that the economy will grow at about 4.6%. Bear in mind that this year the government have projected that the economy will grow about 3.8%. But like we saw, the economy has grown so far about 3.2%, share of the 3.8% the government has projected. Government is projecting crude price about 2.06 million barrels a day. This year, last year projected about 1.78 million barrels a day. Average production third quarter of last year was in the region of 1.47 million barrels a day. Third quarter of last year was 1.47 million barrels a day. Government is planning to grow it to about 2.06 million barrels. That's almost a 50% increase. So, and that we think that's quite optimistic. government is budgeting a benchmark crude price of $75 per barrel. Last year, it had budgeted 2025 for a budgeted $77.96 per barrel. We know crude price had hovered around $70, $72 per barrel, but we think that will moderate further in the current year because of the Trump effect. Government has projected inflation rate of 15.75% this year. Last year, it had projected 21.4%, and then we're dealing with inflation rate of 34.6% as of November last year. Exchange rate is projected about 1,500. Bear in mind, the government had projected exchange rate of 800 naira to $1 last year. And then we know that we're in the region of 1,500, 1,600. Fast as yesterday, it was about $1,660 at the parallel market. That was exchange rate as at yesterday. So if you look at the government projected revenue, government has planning to generate about 36.35 trillion naira. Of that amount, he expects from oil to generate about 19.6 trillion naira. I had told us earlier that total government revenue was just in the region of 6.8 trillion naira as of October last year. So if government had generated about 6.8 trillion naira as of October last year, what will change drastically as for government to achieve a revenue of 36.35 trillion naira? Government is planning to spend about 49.7 trillion naira. The problem is that the government has drawn up its expenditure profile and we spend this money, whether it generates a revenue or not. So that means the budgeted deficit of about 13.39 trillion naira will be far exceeded should government fail to achieve its budget revenue, which we think is the most likely. Government is planning. So if we look at this further, if government is planning to borrow of that budget deficit about 7.3 trillion naira from the domestic economy, about 1.88 trillion naira from internationally, and multilateral agencies about 3.8 trillion naira. But back to the breakdown of the budget, the key thing we must bear in mind that the government is planning to spend about 15.9 trillion naira to service debt. That's about 1/3 of its budgeted revenue. So the government will be spending about 1/3 of government budgeted revenue. But also bear in mind, government generated only 6.8 trillion naira by October last year, which means government is very likely to spend more than it will generate this year in terms of the service, the reality of it. Because if you look at the fourth populated column there, you will observe the actual figures as at August. And I had given us the figures for the federal government revenue. So we now move on. Of course, the figures I gave you were up to October. So of course, if you're going to get this, because of time, I'm going to pepper through this segment. But when you get it, you can look at how we have performed in terms of budget expectations and budget actual. Last year, the government, in order to fight inflation as well as stabilize the exchange rate, became very aggressive in terms of interest rate on federal government debt instruments. We saw treasury base rates go as high as 23.5%. And then we saw OMO rates go as high as 24.32% last year. So the increase in interest rate, which started in February last year, incentivized foreign portfolio investors to come into the Nigerian economy. The figures of capital importation for half year indicated that portfolio investment was about 3.48 billion dollars, whereas other investment, which are basically loans, was about 2.35 billion dollars. The major attraction for an economy that is open to investors is capital, is foreign direct investment. Unfortunately, that was only $149 million for the first 6 months of last year. So most of the money that came in went into treasury bills. About 2.68% of that investment was allocated to about 17% of the total $3.43 billion that came into the economy for portfolio investment went into treasury bills. That's about $2.68 billion. That's part of the fact that boosted your reserve to about $40 billion. So the question we ask ourselves, are we actually facing a debt crisis. Are we approaching a debt crisis? We know national debt as of June was about 134 trillion naira, about $91 billion. Debt service is projected about 15.9 trillion naira. As of August, it was 7.4 trillion. If you estimate based on 7.4 trillion naira as at August, you're going to get something like the region of 12 trillion naira for this year as amount the government will spend on debt service. And what is government revenue as at that same period? So that will give you an idea where we are in terms of whether we have a debt overhang. Of the $42.9 billion, this is a breakdown of the debt we are owing. We're owing China. China is the latest country we're most indebted to among our bilateral partners. So our biggest lender are the World Bank Group that giving us a total about $21.6 billion. So when you look at this, you can observe that why we say that our our external debt is not a threat to the economy yet, but debt service is a problem. And we must bear that in mind in borrowing further, because the amount you are spending to service debt is eating up whatever is should be available to this sector productive activity. So I move a bit faster. Now let's look at the positives. But when we look at the positives, you have to look at the implications of the positives. We've seen a trade surplus, current account balance, positive current account balance in the past 9 months. So we saw a trade surplus of, if you look at those figures, you see that our total trade was about 99 trillion. Export was about 57 trillion last year, and import was about 42 trillion, giving you about 15 trillion naira trade surplus, which is part of what is going into our reserve, in addition to the foreign portfolio investment flows. But of these 15 trillion trade surplus, bear in mind that the factor that drove it are major reduction in imports as a result of the constraint that households have in consumption. So if you look at the second bullet point, so the remarkable increase in trade was largely attributed to depreciation in local currency. Because if you compare the figure of trade for 2023, when exchange rates were devalued middle of the year, and you compare it again 2022, when exchange rate was in the region of 450, 434 naira to a dollar at the official window, which was the basis for measuring trade then. You observe that the jump you see from 66 trillion when the exchange rate was devalued in the middle of the year to 99 trillion was largely driven by exchange rate impact on trade. But in terms of the difference between import and export, consumption had shrunk, which you saw in trade growth of about only 0.6%, because simply people are not able to demand for most goods, and therefore that has constrained the imports. Now, looking at our top major imports. So as at the third quarter of last year, fuel accounted for 22% of our total imports. Diesel accounted for 9% of total imports. And then the two of them alone gives you 31% of total imports. 31.2% are 31% of total imports. So if you add aviation fuel, you are going to get something in the region of about 33% of total import last year was related to fuel import. So in effect, a Dangote refinery and will most likely reduce significantly these import bills. But for us to enjoy the benefit of Dangote refinery, we must ensure that we increase crude production to the extent that whatever crude that is sold to Dangote is not coming from the crude that we currently export. Because if we switch our export to Dangote refinery, we're going to have a zero-sum, become a zero-sum game where whatever we gain in terms of reduction in imports of refined petroleum product will be offset by reduction in exports of crude. Then in terms of the export, if you look at that, petroleum oil, which is crude, accounted for 55%, 65% of our total export. LNG accounted for another 10% of total export. Petroleum gas, about 9% of total export. So in effect, over 80% of our exports is coming from petroleum-related products, crude and crude-related products. Because when you say crude-related products, if crude production diminishes, because our gas, largely associated gas production also decline. So if you look at that, that's 75 plus 10, that's 85% of total export is coming from crude. So it then show you how important, when we keep emphasizing that the shortest route to stabilize the economy is to improve crude production as well as increase food production. These are also captured in these pie charts. Who are the major export customers? In terms of export customers, you have Spain, the United Kingdom, France, Netherlands, and Italy. And what we're exporting, like 85% of your total export is crude and refined petroleum, crude and liquefied natural gas. So this is where we're exporting the liquefied natural gas and where we're exporting crude. In terms of your imports, if you look at the pie chart to the lower end of the right, you will see that China accounts for 24% of total imports. So that's how important China is. So if China, if there's a supply chain disruption in China, it immediately affects what happens here. India is now the second largest import market for Nigeria, followed by Belgium. Belgium, of course, what we're importing from Belgium is a refined petroleum product. The PMS we talked about, the AG we talked about, and Malta. I'm sure you know the story that came into the media about import from Malta. They are largely refined petroleum products. So we have seen an accretion in reserve, which I mentioned earlier, about $40 billion. And that was largely driven improvement in home remittances, as well as process of Eurobond dollar loans that the government took, as well as the domestic dollar loan that the federal government took, added to the impact of foreign portfolio investors. But nevertheless, we still saw a major depreciation in the local currency. Remember that the artificial wind market, Naira closed at 907 Naira last year. I mean, 2023, it closed at about 1,538 Naira in 2024. At the parallel market, it closed last 2023 at 1,206. Last year, it closed at $1,670 Naira to a dollar. So we've seen a reserve accretion without a commensurate appreciation in the local currency. And we will talk about that as we progress. Now, looking at the financial market, I'll just quickly, so that we don't spend more than 45 minutes on this, so I can take your questions. What has happened? We saw equity market gain 37.64%. I've spoken about that. We saw the market that saw a major bullish run in January that gained about 35.28%. And the subsequent months, the increase in interest rates began to impact negatively on the buzz. Bear in mind that the market ended the year at 37.65%, when in a single month, January last year, gained 35.28%. So every that gain was marginal. In fact, the best we saw after that was in December, when it gained 5.56%. In terms of comparison to other buzzes, the Nigerian buzz was among the top performers, apart from Ghana, that did 56%, Malawi that did 55%, Zambia that did 42%, and Nigeria gained 37.65%. So sometimes I've heard people make comments like Nigeria was the best performer in Africa, but that's not correct. So you can use this to prove to them that we are among the top performers in Africa, but not the best performer in Africa. But of course, being among the top performers in Africa also meant that we're among the top performers in the world. You can see the NASDAQ gained 23.31%. And then you have the Nikkei 225 gained 19%. So what are those factors that propelled the market gain? If you look at the sectoral performance, you can see the oil and gas sector was the strongest performer last year. It was driven by Oando that saw an unusual market appreciation. And then towards the end of the year, we saw the government approve the Seplat mobile investment that had been in the doldrum for 2 years. And then, so those factors drove performance in the oil and gas sector. The insurance sector was the next, where people were looking for penny stock, and we also saw major performers like Mansa and Aiko. These are followed by the consumer goods sector, and then you have the industrial goods sector. The banking sector, despite the profitability of that sector, lagged behind, obviously because of policy issues around capitalization of the banks. So this gives you, like I said earlier, we've seen the capital market gain since consistently for the past 5 years. In 2020, gained 50%, gained 6% in 2021, 19%, almost 20% in 2022, 45.9% in 2023, and then 37.65% in 2024. So these are the top gainers. You can see the percentage gains year-to-date change as at end of last year. So you can see Judy gained 1,645. The Oando gained 525%. Suna Assurance gained 877%. And then you can see the laggards, VFD, Multiverse, Dangote Sugar, NASCON, DAS Communication, Thomas Way, and what have you. So, and then, of course, if you look at lower down there, you see the table there will show you that the Asia index gained 13.65%, market capitalization gained 37.74%. So you ask yourself, why was market capitalization gain different from the Asia index? Because they were new listings and they were delistings. So if you look at this, you see new listings, Transcorp, sector, Allied Holdings, also in oil and gas sector. Then you Allied Holdings also among those like witnessed major gains from the time it was listed. Then you have Handel, a real estate and hospitality company. Then the delisting, we saw GSK was listed, Niger Insurance delisted, Griffin was listed, Flamis PLC, Standard Alliance, Tourism Company of Nigeria PS and RAC. These companies are sought for delisting and were delisted last year. Then in terms of market yield, we saw, I mentioned this, the central bank was quite aggressive in terms of trying to mop up liquidity from the economy by increasing rates on short-dated instruments. We saw 875 basis point increase in MPC rate, and we saw a very sharp increase in Treasury bills rate. This all had negative impact on bond prices because we saw bond yields had to adjust to the high yield in the money market space. Of course, if you look at the bonds, we're now dealing with some level of inverted yield curve environment. Then now looking at treasury bills, I've spoken extensively on this, but bear in mind that the central bank raised about 13 trillion naira from the treasury bills window. The government treasury bill, so they took out about 13 trillion from the economy. About 31.3 trillion was taken out by the central bank from the economy, which is why the banks currently are offering yield on money market instruments in the region in the 20s. And we saw a very tight monetary environment within the financial services system. I'm sure you know that lending rates have gone to in the region of 35–40%, which makes it difficult for the real sector producer activities to perform. We've seen OMO yields as high as 32%, effective yield as about 32%. We saw, if you look at this will show you the rates at which the federal government issued, central bank issued treasury bills. You can see that 23.5% was the high that was achieved on 28th of November. And I said earlier that this uptick in interest rates started in February. You can see by 7th of February, the third row, because treasury bills are issued every fortnightly. By the 7th of February, the central bank increased rate from 11.54% to 19% to attract foreign portfolio investors. Of course, that has a very salutary effect on foreign portfolio investment. I didn't mention earlier that foreign portfolio injection into the economy in the first half of the year was about $2.68 billion. And we saw it led to a major moderation in exchange rate. We saw exchange rate drop to about 1,100 sometime in March before it began to reverse. What are those factors driving the reverse? I will come back to that. So this just show you the interplay between the federal government's efforts to the central bank's effort to take out liquidity from the economy and the injection of liquidity into the economy from the fiscal authorities. If you look at that, I did mention just shortly that total amount taken out of the system was about 31.3 trillion naira by the central bank through issuance of 13.8 trillion naira treasury bills, 11.6 trillion naira OMO, open market operation, and federal government bond about 5.8 trillion naira. But conversely, the fiscal authority injected about 14 trillion naira into the economy, 14.1 trillion naira into the economy by way of sectorial allocation. If you see the table by your right, and you look at the second row from the bottom, you will observe that federal government received about 4.5 trillion naira. That's what, excuse me, this was at November. State government received about 4.7 trillion naira, and local government received about 3.4 trillion naira, amounting to about 14.1 trillion naira. And then for state that got under the derivation, they got about 1.28 trillion naira. This is just to show you of this amount that was about 40 trillion that was distributed, 5.4 trillion had to do with exchange gain. And so now takes us to, okay, so you can see the same information more in a more graphical format. Then in terms of the bond market, of course, the effect of a high interest rate environment is that the bond prices will, there will be low demand for bonds, price yield will go up, price will go down. And that's why we saw a bearish run in the bond space. The same thing happened in the Eurobond space. We saw a bearish run, prices went down, yield went up. And that was why when the federal government came to borrow about $2.2 billion, the offers were in the region of 9%, 9.6%, and 10.35% for the 6.5 year and the 2.2, the 10-year instrument that the federal government raised. So now let's look at the outlook. I think this is, for us, the meat of the presentation. We think the economy will record a further improvement in output growth when compared to the about 3.21% we recorded last year. The projected growth will be driven by enhanced crude oil production. I had mentioned the fact that Seplat had taken over Mobile oil field. We also think there will be some improvement in agricultural output, driven by some level of improvement in security situation, particularly in North Central Zone, where the conflict between the herdsmen and the settlers seem to have moderated. Not fully eradicated, but we think there's some moderation. We think the government will try to push back and recover some territory from the bandits in the Northwest. So we think food production will increase marginally, and that will have a positive effect, given the size of the agricultural sector and the economy. We think the approval or the upcoming approval of tariff for the telecommunication will encourage them to invest for that. If you observe, none of them has actually come to announce that they've expanded their 5G network for quite some time, because they seem to be running out of steam in terms of resources. So we think this will enhance growth in that sector, the tariff increment. So oil production, I have explained why we think oil production will increase. Crude production is in the region of 1.5 million barrels a day. We think we should be targeting the region of 1.65 million barrels a day. We think the 2.06 million barrels a day projection is completely beyond what the country would achieve in a single year. The Trump effect had spoken extensively on that. We think the Trump effect will disrupt the oil market, will disrupt global the production, global demand and therefore it stops global production. So we think we are going to see a reduction in demand for Nigerian crude as US increases crude production. But we also think there will be a reduction in crude prices. So for the country to take advantage of the reduction in the increase in demand, I mean the reduction in crude price, to offset the impact of reduction in crude price, the country needs to increase crude production materially. So this is our projection for the economy the current year. We think at best the economy will grow about 3.8%. We think exchange rate will be in the region of 1,500 to 1,550. We think inflation will moderate to the region of 33%, or between 25, 26 and 33%. We think reserve could go to as high as 7 billion if crude production increased materially. We think crude production will be around the region of 1.6 million barrels a day. So now on inflation, as I begin to round up, we think inflation will remain obstinate. Yeah, there'll be a moderation in inflation rate. That moderation will come from the base effect because we're dealing with already a high base. And I need to emphasize this, that when you talk of high base effect, if you use rice, for instance, we're talking about a bag of rice about 100,000 naira now. If inflation is about 25%, this 325, it simply means the bag of rice will move to about 125,000 naira. Not that the bag of rice dropped to about 175,000 naira. So we have to bear in mind that for average households, for their standard of living to improve, their income must outpace the rate of inflation. We are going to see a higher rate of inflation, a lower rate of inflation, lower than what we saw in 2024, but it will not necessarily in the first year lead to an improvement in the standard of living of average households, apart from those who can improve their earnings to catch up with that. So our projection is about 26% of inflation rate, driven by mostly increase in tariff for the telecom sector because of the pervasive impact. We think fuel prices are going to drop this year, as we expect crude prices to drop. So that will serve as some relief to households. In terms of foreign exchange, we think we should see further uptick in reserve. But the challenge we have is that the about $2.6 billion we raised from the market last year, around February last year, will be calling to be paid back around February this year. Remember, most of them are 364-day instruments. So we will have obligations that will mature in terms of money borrowed from foreign portfolio investors, unless the government sustains the very high interest rate environment, higher than what the price they came in. Otherwise, those monies will go. But if to sustain that, the government has to issue additional treasury bills at very high rates. In terms of monetary policy, we think the central bank will remain hawkish in terms of monetary policy. They will continue to tighten, but at a slower rate or at a slower pace. What do we think of the equity market? We think the equity market bodes prospects for discerning investors. There are some sectors we consider will remain vibrant. Those sectors include those few quoted agricultural produce sectors, Okumu, Oil, Presco. We think the financial service sector will benefit from high interest rate environment, high lending rates, high treasury base yield, high yield on OMO instruments. So we think that will be a good sector. We think the telco sector will benefit from a higher increase in tariff. So I've spoken about the banking sector, the oil and gas sector. We think the likes of Seplat will begin to mine the benefits of the acquisition in the current year, and we think they will remain good investment instruments for the investors. For consumer goods, I mentioned the likes of Como and Presco, which are also agriculture. The industrial goods, the likes of Bua Cement, Dangote Cement. We think their markets will remain relatively flat the first half of the year. Probably by the time we move to the second half of the year, we should see some improvement in demand as governments engage more in infrastructure. Remember that infrastructure investment will slow down during the rainy season, and the budget has not been approved. So before the budget gets to the point of disbursement, we would have entered the rainy season. So that's why we think the first half of the year will not build so strongly. With those sectors will remain lightly moderate. I talked about telecommunication sector. Insurance sector is really capitalizing. And the government is likely going to push for more compulsory insurance. The government has said they want to start enforcing third-party insurance. So that will give some booster to the insurance industry. We think bond prices will respond to the direction of interest rate. And for Eurobond, we think investors who are descending enough that want to protect their assets from any possible fluctuation in the exchange rate should we still find the Eurobond space quite attractive. I want to thank you for listening. I'll take questions from the audience.
Thank you so much, sir, for the enlightening presentation. You took us through a retrospective view of 2024's economic landscape, and you also provided an outlook for Nigeria's economy 2025. It's also very compelling to see that the policies are shaping the economy and creating opportunities for growth and development. Your insights today will undoubtedly be valuable for investors and businesses alike to make informed decisions. Thank you, sir. We're now ready to transition into the Q&A segment of our program. We've received several questions from our audience. If you have additional questions, please feel free to drop it in the chat box or use your raise up icon to notify so we can address the questions. So I will just go to the first question we have. We have a question from Mr. Michael Obona, and his question goes to us. There has been a narrative that most of the sold upstream assets sold by IOCs to Seplat, Renaissance, Owando, and others were drained and dry well dumped on local players by those who have their advanced technologies to ascertain the unproductive nature of these wells, despite the masqueraded reasons of focusing on deep offshore as business decision. What's your take? So I'll just take this one question since it's quite robust.
Go ahead, Falake.
Okay,
Okay,
so
I just take this question. Okay,
yes, yes.
I think I don't know where that information is getting from, but I know that for instance, what I know is that the oil majors, the likes of Mobil, could not continue producing their onshore assets. And if you bear in mind that they did not sell their deep offshore assets, they couldn't continue producing their onshore assets and shallow offshore assets because of the insecurity in the Niger Delta region, because of breach of pipeline, difficulty in evacuation of crude, the losses along the pipeline, the theft of crude that was produced by them. So they felt that maybe local operators may have better understanding of the local terrain. And because they are also subject to some other international standards, they could be sued in their home countries. So they couldn't just comply, or they couldn't adapt to the peculiarities of our own environment. And many of them decided that the best option for them was to exit the shallow offshore and onshore assets. So it wasn't because the wells were drained. And bear in mind that these companies that have bought these assets have knowledge and competencies as to carry out due diligence. And then there is, I'm sure they have geosurface seismic data. They have seismic data that they are in their possession that determine the level of hydrocarbon bearing capabilities of those fields that they bought. So it wasn't the blind shoot that those Nigerian locals invested in. So I think it might be presumptuous to assume that those people who are blindfolded and invested in those fields, they would have done their studies. And I think those studies would have shown that these fields at a reasonable hydrocarbon bearing asset level. So just to add, for those who have raised their mind like Dio, I think we need to give them access to speak. Anybody who wants to speak can raise your hand, and then we will enable you to speak. I mean,
okay. So
you will unmute them to speak.
Yes, please, you can unmute and go ahead. I'll start with Mr. Dayo.
Okay, thank you very much, Carrie Wise, and it's been a very brilliant presentation. So you've earned your accolades. So I'll just go straight to the question. I lead a couple of investors that are investing in Nigerian markets. Over time, I think one of the things we have continued to see is how the Nigerian economic sort of defies the logical flow or the traditional flow of things. My question is to you, Mr. Chukwu, and thank you again for very insightful presentation. Is one, given your own postulation about the distortion in the oil markets, where do you see Dangote's production, how it affects the local markets, the sub-regional markets, i.e. West Africa, and the regional markets, and how that should play out in Nigeria's economic prosperity over the next 1 to 3 years? That is one. Two, I think one of the major significant leaps when it comes to growth in terms of performance is the Nigerian financial sector. Though you mentioned that ICT and all of that, and given the so much interest in inclusion of illegal activities and all what's into the GDP. So, are you expecting that there will be a traditional distortion in the contribution or the growth or the prospects of the financial sector in GDP determination going forward? So first is oil, second, financial sector. I think the final thing I'll just say within my 1 minute of closing is there, from what you see, based on the data you have analyzed, is there an organized and formal way of investing in the ICT sector in Nigeria? Thank you very much.
Okay, thank you, Dayo. It's a pleasure to have you here. I guess most people do not know the personality we have here in you. But let me save you that by not reading out your profile. But I guess, like they say, if you know, you know. Eh? So, okay, so starting from the oil and gas oil sector, the question ended up with what do I think would be the impact of Dangote in the local oil sector, the regional oil sector, and the sub-regional oil sector. I think Dangote has achieved something so far, and that is to decouple the price of refined petroleum product to the fluctuation in global markets. If you observe, there was a flash hike in crude prices in the past couple of days, since the US has threatened to enforce restrictions on crude from Russian crude as well as the Russian refined petroleum products. There was a spike, but interestingly, refined petroleum products continue to decline because Dangote did not adjust immediately to that. Because Dangote is now getting crude, a reasonable, I think about 350,000 barrels a day from NNPC. So with that being priced in Naira, so a lot of the impact of Dangote refined petroleum product will depend on the exchange rate, because the exchange rate fluctuations will also affect the price at which Dangote gets crude and at which Dangote sells refined petroleum product to the country. So Dangote, but the most salutary impact of Dangote's refinery would be if Nigeria's crude production is increased by about 350,000 barrels that were given to Dangote, so that the 33% that we are spending on import of refined petroleum products is completely eliminated, and it is not substituted by a reduction in the export of crude. In terms of the regional market, which is the West African market, Dangote refinery is now the biggest refinery. Of course, they say it's the biggest in Africa among the world. But remember that countries like Ivory Coast has a refinery, and Ivory Coast has been exporting refined petroleum products to other West African countries. So the competition will be a head-on competition between Dangote and... So in terms of the African market, Dangote is likely going to take the likes of Ghana, likes of Benin Republic and some other countries. But Ivory Coast will sustain its competition in those Francophone countries like Senegal that is closer to it, right? Because it's now going to be a matter of logistics, because the cost of logistics of refined petroleum is quite expensive. So in terms of the global market, I think that would be a tough call for Dangote to compete beyond the African region. The simple reason that crude cost, transportation of crude from the MENA region, that is the North Africa and Middle East region, including Saudi Arabia, is closer to the refineries in Western Europe. So those refineries will have get the crude at lower logistic cost and sell the refined petroleum product at lower logistic cost to the European countries. So Dangote should focus his competition on sub-Saharan African countries. And I believe the market is big enough to consume its entire production. Nigeria market is already big enough. It's the biggest refined petroleum product market in Sub-Saharan Africa, shy of but for South Africa that has a higher demand. So in terms of the financial services sector, your question is, how do we, can you just rephrase your question? Probably I'm missing part of it. Dai, are you there? Okay, before you get it, maybe by the time I finish, and is there any, then you talked about the GDP rebasing, and you talked about bringing some illegal activities into the GDP computation. I think by mentioning that illegal activity, I think it's going to be a tall order, because neither the patrons nor the practitioners are ready to disclose their income. So if government wants to measure that activity, the government has to legalize it, make people to declare it, put structures in place to monitor it and measure it. So otherwise, it's going to be a tall order to assign weight to that. Okay, yeah, you're on financial services sector. I remember your question. I think what will happen is that in rebasing the financial services sector, they're going to bring in the likes of the pension fund administrators. We have become a huge segment of that, the financial service sector. Apart from the banks, in terms of assets under management, the pension fund subsector is the second largest contributor in terms of asset under management, in terms of employment, almost in terms of all parameters, because they are bigger than the insurance subsector. So I think that's what they bring in. So you're going to see an expansion in the size and contribution of the financial service sector. It's no longer just be finance and insurance. It's going to be entire financial services. So we should see that sector expand in terms of contribution to the GDP beyond the current 5.5% that it accounts for. Then I always like to answer this question that when we say that our economy had defied all logic, because we have a huge shadow economy that is not measured, that does not have cost of production, that has liquidity and distorts market forces. So I think that's one of the reasons why, because I have sat down last year to study why does our economy defies common economic logic. And I stumbled on a huge shadow economy that may actually be bigger than the formal economy. So the other people who have raised their hand, I hope that that has given some level of clarity to your questions.
Thank you, sir. I would allow Mr. Victor to ask his question. Please kindly unmute and ask your question.
Thank you very much for wonderful presentation by Johnson. I'm going to talk about the crude prices. Here in North America, most of the crude produced by hydraulic fracturing, and if the cost of crude goes down below $50, most of these companies in shale gas, shale oil cannot produce. So given that perspective, how does it play with the fact that, we're expecting lower cost of production, and knowing also very well that if these companies, crude oil goes below 50, then a lot of these companies will not produce. How does that, what is Johnson's take on this low oil production? Thank you.
Thank you, Victor. Thank you for waking up to join us so early. So our take is that crude price will not drop below $60. We should the region of $60 to $65. That's our estimate. But we also believe that Donald Trump will encourage technological advancement or investment in technology that would drive down the cost of production, extracting crude from hydraulic fracturing technology. We think it will do that because with that, that will allow America to explore a lot more of its oil wealth. So ultimately, because of advancement in technology on a daily basis, the cost of producing crude from hydraulic fracturing technology will further reduce in the coming, even in the current year, below the $50. But our estimate of crude price for this year is in the region of $60 to $65. Okay, I guess for like you are there. So there are also people on the
Yes. We'll take
question. So you maybe take two of them then before you ask the next person if there's anybody who has raised his hand.
Okay, so
that we
I have a question
attend.
from okay, that's fine. I have a question from Olayinka Mark. He has asked, what do you think about the monopolistic approach of Dangote Refinery and its level of disruption in the downstream sector and effect on bank finance? I think you've spoken a lot on Dangote Refinery, but do you want to take this question?
So what do I think about the monopolistic approach? In terms of monopolistic approach, it's something the federal government has to moderate. The federal government must not allow for a monopoly that is disruptive, unless you're talking about a benevolent monopoly. But it's difficult to remain a benevolent monopoly forever because the hubris of being a monopolist will one day set in and then lead to abuse of that monopoly power. So what the federal government can do is to create a window for oil and gas traders to still have access to import. So once there's a trade that they can import, if Dangote prices are not in tandem with global prices, then Dangote will never mark up his price to be at variance with global prices. Rather, he will want to keep a price below global prices so as to pass on the proximity benefits of the refinery to the Nigerian market. I think that's, but they shouldn't shut out importation completely so that even if the window remains just a threat, that traders have the capacity to import whenever the international prices are more favorable than Dangote Refinery. And then Dangote Refinery would not allow that to happen because they want to sustain their catchment market. But if the licenses are revoked from them, then at some point, the hubris effect will set in. I think, let me also take this question. For like, if you go up, you will see a couple of questions. There's a twin Mike that's asking what are our thoughts on real estate in 2025. Our thoughts are the high-end real estate market will remain vibrant. We saw a price appreciation of 100% in the high-end.
He has asked, what's your thoughts on real estate for 2025?
Yes. We saw a market appreciation in the high end of the real estate market of more than 100% last year. We think it may not be 100% this year, but it will remain strong because of what I call the shadow economy. We are seeing liquidity coming to that market not from established business persons, not from people with well-established income sources. In as much as we're not, but we think for that trend, unless there is a major slowdown on level of what they call public sector corruption, if there is no direct confrontation of public sector corruption, we will see continue to see shadow economy grow. And the impact of that the real estate business or investment looks like the surest and most anonymous way to store their wealth. So, but in terms of, if you go beyond the high-end properties and you go to the retail, low-end properties, there have not been major shifts in their prices. Of course, some of them have adjusted to some extent to inflation. So we think what will happen is that real estate will continue to adjust to inflation, adjust to exchange rate movement, but high-end real estate will outperform both inflation and exchange rate depreciation, driven partly, let me not say it's not only a factor, partly by the shadow economy.
Thank you, sir. I'll take another question from Choma. She has asked, is it advisable to invest in insurance stocks like NIM insurance and ICO insurance at the moment? Secondly, is shares of Owando a good buy at the moment?
Well, these are frontal questions that you don't want to answer in a public gathering like this. But what I would say is that consult your advisor. The stock prices are not constant, are not fixed. They move on a daily basis. The price you can go into, may not be the price you go in tomorrow. The market has a window of plus minus 10% price movement. So if the price are moved by 20% in 2 days, it may not be advisable at that point to go in. So what we do is that we give people a study that shows the low for the past 54 weeks or 52 weeks and the high that attained for the past 52 weeks. When we're carrying out our basic research. And then we also tell you what is the return on investment, what is the dividend yield, what is the earnings yield of that stock at that market price, and what's the PE multiple. We need to have these figures for you to advise you on whether to invest in NEM or ICO or Owando. But if you can do this basic analysis via our subscriber, we have capability to do some basic research for yourself using our tools. But otherwise, call any of us. We do this research for you free of charge and advise you. We will give you their PE multiple. We will give you, which will tell you how long it takes at their current earnings to pay you back the amount you have put in. We give you the dividend yield. We give you the earnings yield. We compare with others in their industry and we compare with the market indicators, variables. And then we'll advise you in a more concrete term whether they are good to buy at current prices. But bear in mind that fluctuations in market prices can also guide in whether to go in at that point or wait for a more auspicious time.
Okay, thank you. We have a question from Mr. Chirindo from the Sun newspapers. Nigeria has continued to borrow, and according to your estimates, at least the borrowing has grown to 12.8 million. What can we do to prevent us from falling into debt crisis?
Well, I think the government needs to review its approach to funding infrastructure. As we speak today, there's no kobo that is invested in infrastructure is actually from government revenue. Every money that one kobo that government invests in infrastructure is borrowed. So if that be the case, the government should restrict itself to what social infrastructure, health facilities, or health infrastructure, educational infrastructure that the private sector may not fund, particularly for those underprivileged in the society. Create a window that will allow them access healthcare, educational facilities, and then government will allow private sector develop the appropriate legal and commercial framework that will allow private sector to invest in some of the particularly commercially viable infrastructure, and then free up government resources. The governments in Nigeria are not known to be the best investor in terms of value for money. So embedded in every government expenditure are leakages, which we can eliminate if we bring in private sector to invest on those things. So that's my approach. And then private sector will grow the economy, government tax revenue will grow, and government will have more resources. And then we will upturn the current obtuse fiscal framework we have in the country. But like maybe you take a few persons to speak, and then we'll go back to the question and answer. The ones that are.
I agree. I'll allow Mr. Udo Okon to speak. Please unmute.
Okay.
And ask your question.
Good afternoon, sir. Good afternoon, members of the seminar. I just want to ask two questions. The first one is you mentioned that when price goes up, yield comes down, or when yield goes up, price comes down. I wanted to find out what's the difference between the price and yield. For example, if 100 million naira treasury bill and the yield is 23%, that makes your income for the year, if it runs for the whole year, 23 million. So I was of the opinion yield is the return. So what then is the price? Are they not the same thing, or what's the difference? Then the second one is about the liquidity, withdrawal scenario. You mentioned that treasury bills was withdrawn. I mean, people placed treasury bills, 13 trillion thereabout, almost 13, and then bonds of totaling around 31 million. And also there was a high lending rate, thereby discouraging access to funds. All of this in an attempt to reduce funds in circulation to reduce inflation. Meanwhile, inflation still exists. Why? Was it due to fact injections? Or what are the other means that funds find their way into the economy to cause expected inflation? And how come inflation still goes up despite withdrawals and high lending rates? Is it due to the increase in foreign exchange rates that you mentioned was 1,200 to a dollar in 2023, but moved to like 1,600 as at year end 2024? So I just wanted to the scenario, despite the liquidity withdrawals and high interest rates that discourages funds being in the economy, which should cause inflation. Inflation still goes up. So what is the factor necessary, or why is it like that? Then the first question, the difference between price and yield, even a 100 million treasury bill. Thank you.
Okay, taking from the first question, let me use a graphical illustration. Assuming you have a bond that is trading apart, and the bond is a 100 naira bond, and then the coupon on that bond is 15%. When the coupon is 15% and the bond is 15%, the yield is 15%, which is 15% 100 naira will give you 15 naira. So at that point, your yield is equal to the coupon. If the price of that bond goes to 150 naira, for instance, just to make it very graphical, and you remember the coupon on it will still remain 15%. So if the coupon will not change, so the yield will drop because they will pay you 15%. If you buy that bond that used to be sold at 100 naira, if you buy that 150 naira, your cost of that bond is 150 naira. And the coupon you will get at the end of the year is 15% of 100 naira. Remember that you bought at 150 naira. So for you, the cost of the bond had gone up to 150 naira, but they will pay you 15% on 100 naira. When they pay 15%, it becomes 15 naira on 150 naira, which will give you a 7.5% yield. So you see that your yield had dropped because the price had gone up. Conva is also the case. If you bought the instrument at 100 naira and the coupon is at 15%, you get 15 naira at the end of the year. If prices had dropped to 75 naira, okay, at the end of the year, and some other person buys from you at 75 naira. So what the person will get, they will get 15%, they will still get 15 naira because the par value is 15 naira. You still get 15 naira, but had bought from you at 75 naira. So the person will eventually get a yield of 17.5%. This is the concept of it. If rates are going up, people will buy your instrument at an effective yield that mirrors what the market is doing. If rates have moved from 15% to 17.5%, and you want to sell you have a need to sell your bond, nobody will buy that bond from you at 100 naira. They will tell you know what, bond, I can put this my money in another instrument that give me 17%, 17.5%. So if you are ready to sell your bond at 75 naira, so I will buy from you because my yield, target yield is 17.5%, and that's what I'm getting elsewhere in the market. So when yields go up, people who are holding bonds, we are forced to sell at lower prices because they have to sell at a yield, effective yield that mirrors what the market is. I don't know whether this explains it to you using those graphical illustration of 100 Naira bond and a coupon of 15%. Then back to your question on what is propelling inflation. There are two factors propelling inflation. One is liquidity injection coming from the shadow economy, which I think I've said enough for us to understand what I mean by shadow economy. Two, the pass-through effect of Naira depreciation. I'd say that last year, the exchange rate closed at 907 Naira to $1 at the official window, but it closed at 1,583 Naira, 84 Naira to $1 last year. It's closed at 907 in 2003. So the pass-through effect of that is that anybody who imports goods from the country at 1,500 will have to pass it on to the consumer at exchange at 1,500. The third factor is shortage of food supply, shortfall in food supply, or what we are now calling food insecurity. If, of course, I showed us that the food agriculture sector is now about 1.14%, while our population is actually now about 2.4%. So that means we're having more mouth to feed than the food production taking place. So that means that if there are 10 tubers of yam, and that 20 of us want to buy 10 tubers of yam, the seller will likely increase the price. Not because we have more money, but we will pay more to buy it because we have to feed, because it's what you may call non-discretionary consumption. People must feed to live. So because we are producing fewer quantity of food comparable to the number of people in the country, so the prices, people are bidding up the price of those food items. And that's the next factor driving inflation. So one, you have liquidity injection coming from shared economy. So you also bear in mind that I say that the central bank took out about 31.3 trillion naira from the economy. At the same time, the fiscal authorities injected about 14.1 trillion naira in form of allocation to our government. Not all those money that went to our government went to productive activity. Because when they go to private, they will incentivize, they will create jobs, and then those people will make normal demand. But once it doesn't go into, part of it don't go into productive activities, which is why I keep emphasizing shared economy. You're having a liquidity that's in public economy that has no cost. And those are the factors that drove up inflation figures.
Okay, thank you. We would allow Mr. Matthew Kalu to ask his question. Yes. Please unmute and ask your question.
Okay. Hi, good afternoon.
Good afternoon.
Oh, thank you so much. Thank you, Sir Johnson. I quite appreciate this opportunity. So I just have four short questions. I joined from Port Harcourt. One, when at the introductory part of the presentation, you were talking about the trade relationship between America and China, America and Mexico. Then you talked that of Canada, but I didn't get the trade relationship. So I wouldn't know whether it's a product or whether it's manpower that they provide that actually creates the trade relationship. So I would like to know. Secondly, I also saw that there is this trend in borrowing, the government borrowing from one year to another, irrespective of the same government that is in power, the same person that is in authority. So I wanted to know, is there a time actually that we can actually experience a reduction in the trend of the borrowing? You know, if it's 10 Naira today, the next year is 12 Naira, the next year is 13 Naira, as the case may be. Is there a time that this trend can actually slow down? What are the things, what are the indices that actually cause this?
I think we lost him. Is it me, only me that I've lost him?
I also can't hear you. Okay, so
Okay, I think we can
yes.
address the first two part of this question. What does Canada export to the US? Canada currently exports iron and steel to the US. Canada exports aircraft equipment to US, paper and paperboard to the US. And Canada's volume of sales to the US runs into billions of dollars in these aspects. But there are also a lot of production manufacturing activities in China, in Canada, that are basically devoted to the US market. So like we said, they have the longest land border, but beyond the trade, the movement between US and Canada is almost difficult to, in some areas like in East Coast. It's difficult for you to know when you cross the other border. But imposing tariffs on whatever is coming from Canada, because if you go to the border between Canada and US, you see a lot of trucks crossing, carrying manufactured goods to the US. It will be difficult to enforce it. Enforcing it will mean that maybe they also have to start building another wall, like they say they want to build a wall across Mexico. So, I think the next question is that every year, every government that comes to the country continues to borrow. I think my answer to that is that if you do the same thing time and time again, you get the same results. Which is why I'd say that for government to stop this borrowing, that the government needs to review its approach to funding infrastructure and realize that we don't have the economic resources to fund critical infrastructure from budgetary allocations. So we need to review that and adopt an alternative funding mechanism that will bring in private capital to fund infrastructure. And then we have a proof of concept. Until 2000, the government was funding telecommunication sector. Through NITEL, government was trying to build telecommunication masts. You have to bribe, bully, beg, be in government for you to have telephone at home. And then the government recognized that they cannot continue to do that, adopted a transparent licensing approach, gave out licenses to mobile telecommunication operators. Today, Nigeria has over almost 200 million active lines. There is telecommunication service on almost every nook and cranny of the country. And the government had not spent a dime, that government collected licensing fee of $285 million times 3 places or 4 places. If you take out NITEL's payment, you had 3 the government collected. Government collected over $1 billion as licensing fee, and then government still collecting taxes from them, and we're enjoying better services. So we can also replicate that concept in multiple areas where government tries to build infrastructure that doesn't have capacity to build.
Thank you. We'll allow Mr. Michael Ubuna to ask his question.
Okay, thanks for the opportunity. Doctor, I agree to you. Thank you very much for the comprehensive analysis. I wanted to ask 2 questions. One, do you think the banks will later do share reconstruction after the raises, like they did the last time the capitalization was done by Dr. Soludo? Second, what do you think about local banks funding downstream players to purchase of their products from local refineries? That is in respect of their bank's profitability and also the risk exposure to these banks.
Okay, in terms of capital reconstruction that the banks did sometime in the past, I think the banks are also a bit more circumspect in the volume of shares they are coming to the market with. If you observe, many of the banks are coming at quite high prices, and then at their current profitability level, they can comfortably maintain high dividend payment on even the large capital base. But you don't rule out, strategies are dynamic. Strategies could come and banks now see they want to have a more manageable capital base or listed shares, or the banks may even go into buyback and cancellation of shares. All those things are possibilities in the future. But the current environment, current profitability of the banks will suggest that the banks can sustain very good dividend payments even on the enlarged number of shares after capital raising. In terms of the bank funding their downstream customers to buy product from local refinery, I think it's something that will certainly happen. They will now need to work with the local refinery, particularly the Dangote refinery. But as I speak today, Dangote refinery has enough customer base that it does not need to bend backward to go to a bank and say, look, like what it did with its flour and cement distributors. Now there is limited competition as we speak today, and it has not achieved its full capacity of refining. Its full refining capacity. So that may not. But I believe banks, customers who have the financial muscle, who are creditworthy, can still go to their banks and get overdraft line to enable them trade with the refineries.
Okay.
Maybe you take two more questions from the question list, and then we take the other two persons who have raised their hands, and then we'll try and round up.
Okay, that's fine. So we have from Anonymous, please shed more light on the GDP and CPI rebasing and the effect on the subsequent data prints. Should we take two at a time so that?
Okay, go ahead.
Okay. So we have another question from Ian that says, what's the economic measures that can be put in place to arrest the rate of inflation in the economy?
Okay, starting from the GDP and CPI rebasing, they are going to bring in some sector that we are not previously captured, one of which is, I think I did mention it in the course of responding to Dio, the area of what do you call what do you call them? Things like HMOs, which have become a very pervasive sector. They are not captured in the financial service sector. You have the pension fund administrators, they are not currently captured in the financial service sector. There is a comment that they want to bring in things like, when I was in the word illegal, prostitution and all those things, that they now consider economic activity are not captured. And my position that it's not measured. The people who are indulged in it, either the patrons or the practitioners, are not willing to disclose their practice or their income. So for government to do that, they have to go the direction of Netherlands, where it be legalized, and then they will be giving licenses, and they can be taxed, and the government can measure the activities. But aside from that, there are other services that are currently not captured. The economy is actually very dynamic. A couple of things have actually changed in the past 1 year. There are activities today that are barely captured. I'm sure you heard of Dirty December, where if you have seen what's going on in social media, the kind of monies that we are spent during the last 6 weeks of last year. Such level of economic activities may not be captured. Some social activities like people, weddings, events, social events, unless they take place in places like a hotel, they are hardly captured. So they want to capture in some social services, some financial services sector that have evolved over the last couple of years. So I don't have the comprehensive list, but by the time they finish their report, they will present us with a comprehensive list of what have been reflected in the new GDP and the new CPI. So what the next question is, you asked two questions.
Okay, the next question was from you guys. What are the economic measures that can be put in place to arrest the rate of inflation in the economy?
Well, I think there are two major things the government needs to do. One is push back on insecurity in the major food base of the country. Like I said in my presentation, 39.93% was in food inflation in November. If the people in Benue, people in Southern Kaduna, people in Plateau, people in Nasarawa can go back to their farms and produce the same quantity of tuber they used to produce, we're going to see a moderation in food inflation. If people in Zamfara, people in Katsina, people in Sokoto can go back to their farms, people in Borno and all the northeast states can go back to their farms. Taraba, these are very high prolific agricultural zones. Then we're going to see a similar moderation in food prices. The other thing is to increase crude production so that at least that 3% we spend on refined petroleum products is fully saved without reducing the amount of crude we are exporting. That way, your demand for FS will reduce, your earnings from crude oil sales will improve, and then your current reserve will increase on a sustainable basis, and your exchange rate will improve. If exchange rate drops to the region of 1,200, which we are not projecting, 1,200 or 1,000, well, it was 1,200 in December 2023, then you're going to see a material decline in price, including refined petroleum price. So that will drive down inflation. We can actually see if crude oil price drops to below 1,000 below, I mean, if pump price of fuel drops to the region of 750 naira to a liter, you will actually see deflation, not just disinflation. You're going to see a reduction in prices. So that is the way to go. But two major things: focus on improving agricultural production and focus on improving crude oil production.
Okay, thank you, sir. We'll take 2 more questions and then allow 1 live question. I'll take from Oladimeji Sani. Please, is 15% interest rate achievable by federal government, and what can be radically done to bring it below 20%? And second question from Joseph Alfred. What will likely be the impact of Trump's administration on the global economy, given to the fact that the Gulf of Mexico and Panama Canal is threatened by Trump's administration?
Okay, I think Joseph's question I actually addressed at the beginning of my presentation, and I talked about the impact on trade, the impact on arms race. We're going to see a shift in economic investment from economic to military by major powers in the world. We talked about increase in trade barriers, tariffs that countries are going to retaliate with imposition of tariffs. So in terms of Mexico and Panama, the problem is that if the US goes ahead and annexes Greenland, which is part of Denmark, and then forcefully take Panama Canal and threaten to make Canada the 51st state of the US, they will automatically encourage China to attack and forcefully try to take Taiwan. Should that happen, would you guys go to defend Taiwan when it's living a contrary philosophy from what is trying to prevent China from doing? So how this will pan out globally is not certain, but clearly we're going to have a more militarized world from this year than we used to have. We're going to have less emphasis on globalization. More countries are going to be more nationalistic. Countries are going to be try to do everything to try to be independent of other countries or be largely autonomous, produce what they can produce. The area of outsourcing of manufacturing activities will reduce with the philosophy that Trump is trying to adopt.
Okay, thank you, sir.
Then the first question that came from Oladimeji Sani, I had said that it's nearly impossible for the government to attain the 15% inflation rate. The government actually budgeting about 13.3 trillion naira as deficit. That deficit will be materially higher than that because the 36 trillion naira government is projecting as revenue is unachievable. In my presentation, I made it clear that we've at best done 12 trillion as at November, as at August. So if you use that around it, you have about 16 trillion this year. And at 16 trillion, you cannot go to increase to 36 trillion. So that's nearly impossible, 20 trillion additional. But the government likelihood to spend is 47 trillion. So with me, government is going to borrow a lot more. And that borrowing will enjoy liquidity if we borrow from the central bank and make it much difficult. Liquidity availability will be among the things that we counterbalance some of the things we are saying. The possibility of inflation reducing to about 25%, as well as exchange strengthening. If the government borrows massively beyond its target budget deficit, we may see a reversal of what the things we are thinking, we are projecting that will happen.
Thank you. I would like to give Dr. Bayo Lubimi his answer. Please, can you go ahead and ask your question, sir?
Thank you very much. It's not a question per se, because I came a little bit in late. I just want to make a comment that to commend the carry asset and the GMD for this initiative. And of course, the questions that have been asked so far, they've been answered satisfactorily. We are believing that this year, 2025, will bring about prosperity for our nation and for our different businesses. And also believe that the government will invest heavily in infrastructural development, including the power sector, the rail sector, the transportation, and the rest of them. And I want to thank everyone who has participated so far. And once again, I want to commend the GMD for the delivery. Like I said, I came in late. However, I know the stuff is made of. And the way you answered the questions that were thrown at him were well done. Thank you.
Thank you, Director. Thank you, Dr. Bayo. Thank you, Pastor Bayo.
Thank you so much, sir. Unfortunately, we will not be able to take more questions, but be rest assured that your questions will be answered too. We are restricted. We're supposed to wrap up by 2. Okay, so I also want to thank you, sir, for your insightful responses to the questions asked. We also appreciate our guests. We would like to invite Mr. Henry Nwagodo to give us a vote of thanks.
Okay, good afternoon, everyone. Once again, I want to thank our Group Managing Director, Mr. Johnson Chukwu, this presentation for your... Sorry, can you hear me?
We can hear you. Go ahead, please.
Okay, for your inspiring leadership and commitment to empowering stakeholders in making an informed decision. We also want to use this opportunity to appreciate all our clients, partners, and participants that joined this section. It was nice having you. Your presence here today and your participation has made this section very interactive and informative. We want to encourage you that as an organization, we remain committed to supporting your journey to wealth creation, and we look forward to having you at the next section. This has been our first section in 2025. We hope to see you again in the next session. Why? We look forward to having you. We want to encourage you to make our time to visit our website, follow us on our various social media handles, where you can get more information about our services, about our products, and someone will be available to attend to you. Thank you once again for joining, and God bless you.
Thank you, everyone. Thank you for joining in. We encourage you to continue to follow Cowrie Asset Management for informative content and investment opportunities. You can also feel free to send your questions to info@cowrieasset, or you can visit our website at www.cowrieasset.com to see our products and services. A special thank you to our esteemed guest speaker, Mr. Johnson Chukwu, for sharing valuable expertise with us today. Our next session will be in the next quarter of Q1 2025. We'll be delighted to have you join us then. Invitations will be sent out through our social media channels and other platforms as usual. Thank you all for joining today. We look forward to seeing you in our next webinar. Thank you and God bless.
Yes, there are people who are asking for her to get, if you have registered with your email address, you're going to get both the recording and the PowerPoint presentation. Thank you all. for joining. We really appreciate your presence here and your questions. And see you again in April. But feel free to reach out at any time. We're available to work with you in time to create wealth for you and your family members and your businesses.
you.